Every single day, millions of people stare at a chart and ask the exact same question: do I buy this or do I bet against it? And the answer, as frustrating as this sounds, is that both are completely right depending on who you are and what you actually want. Let's back up for a second, because the word shorting alone sends half the room running for the exits. When you buy an asset, you're essentially saying, I believe this goes up. And when you short it, you're saying, I believe this comes down. And both of those are legitimate market views held by some of the most sophisticated investors alive. Now, here's where it gets interesting, because the average retail investor was told for decades that buying and holding was the only respectable strategy. Meanwhile, hedge funds were quietly printing money on the downside, and most people didn't even know the game had two sides. Think of the market like a weather system. Buying is like packing sunscreen because you believe it's going to be a great day, and shorting is like bringing an umbrella because you've read the forecast and you don't trust the sky. Neither person is wrong, they're just prepared for a different outcome. The emotional psychology here is absolutely fascinating because buying feels optimistic, it feels American almost, while shorting gets painted as pessimistic or even villainous. But remember 2008, when the entire housing market collapsed, and a handful of traders who shorted mortgage-backed securities didn't cause the crash, they just saw it coming before everyone else did. There's a reason the film The Big Short became a cultural moment. It cracked open this idea that you could be right when everyone else was catastrophically wrong, and that being a contrarian wasn't reckless. It was sometimes the most rational position in the room. The irony is that the people who looked like the crazy ones turned out to be the only adults in the building. Historically, markets go up about 70% of the time on an annualized basis, which statistically makes buying the higher probability long-term play, but inside that 70%, there are brutal corrections, sector rotations, and individual stocks that go to zero. Understanding when you're in a bull cycle versus a breakdown is the skill that separates deliberate investors from lucky ones. Here's the misconception we need to destroy right now. Shorting is not gambling any more than buying is, and the risk profile actually depends entirely on how you size and structure the trade. Unlimited loss potential in a short comes from holding naked positions with no discipline, not from the strategy itself. And that's a risk management problem, not a strategy problem. So what does this mean practically for you? If you're a long-term wealth builder with a 10 to 20-year horizon, buying quality assets and holding through volatility is still the most proven path. But if you're an active trader or a portfolio manager, having the ability to short gives you a hedge that protects your gains when the tide turns. The goal isn't to pick a side religiously, it's to have the right tool ready for the right environment. Here's the lesson history keeps trying to teach us, and we keep ignoring the traders who blew up in 2008, in 2020, in 1999, weren't destroyed by their directional bias alone. They were destroyed by position sizing and refusing to cut losses. Whether you're long or short, if you're risking 50% of your portfolio on a single conviction, you're not investing, you're praying. The most disciplined investors treat buying and shorting the same way a chess player treats offense and defense. You don't commit to one exclusively. You respond to what the board is showing you. Process over prediction. Always. At the end of the day, the market doesn't care about your feelings, your thesis, or your YouTube comment section conviction. It cares about price action, liquidity, and time. Discipline, sizing, and consistency aren't the exciting parts of this story, but they are the parts that keep you in the game long enough to actually win. Whether the market rips higher or crashes through support, the prepared investor is never panicking. They've already mapped the scenario, sized accordingly, and accepted both outcomes with the same rational calm. Comfort with uncertainty isn't weakness, it's the actual edge. So the real answer to buying versus shorting isn't a rule, it's a mirror that reflects your goals, your timeline, your risk tolerance, and your ability to stay emotionally neutral when the trade goes against you. Choose the strategy that fits who you are, not the one that sounds the most impressive at dinner parties. And whenever you're ready to put real capital to work, whether that's in real estate investing, home contracting projects, or finding the right lenders to finance your next move, check out our links in the description below and let's build something together.